Oops, wrong thing. There we go. Okay, today what we're going to do is hopefully we'll complete the chapter. Chapter 7 in a handout. It's not too. It's not too much. There's two parts to it, and that's all we're going to do tonight. And next week you guys are off, so it's your break. I don't want to give anything over the break, so so we'll do the chapter 7 and 8 handout, and we'll forget about it until we come back from break. So I think you still have to turn in well, if you haven't already, there's still an exam to turn in. The chapter 6 exam is due, I think it's Friday. I think I put it on as Friday. But anyway, yeah, so that would be the only thing you need to turn in before the break. Nations they need to, but should. Okay, so chapter 7 and 8 handout. Is anyone that did not get the chapter 7 and 8 handout? I sent it a little early because I think that there's a delay in Blackboard. So I think I'm going to start sending stuff like a half hour early. The class won't start obviously a half hour early, but I'll send out the stuff a little bit earlier so that it has time to get to you. Okay, so I'm showing I'm having 2 Zoom meetings. Okay. Hopefully you guys are at the one I'm at. All right, so what we're going to do then is pull up the handout. This thing. So the bank reconciliation. And we do what they call a bank reconciliation, which for many of you is going to be new. So, so bank reconciliation. And I think let's put it up here. What is a bank reconciliation? It is you'll get your bank statement at the end of the month. Okay, so you get a bank statement at the end of the month. But you'll also have your accounting records. Okay, so you also have your accounting records for the cash account. Now, what we want to do is find the corrected balance. In other words, what's the correct balance for our cash? I know it sounds like it should be easy, but it's not. So what's the correct balance? And so here's what happens. There'll be things on your bank statement that you didn't know about. And so you're going to have to make the adjustments on your books for those things. Now, there's also going to be things that go the other way. there are going to be things that you know that the bank doesn't know. There are going to be things in your accounting records that you know happened, but the bank doesn't know, or at least they didn't know at the end of the month when they made your bank statement. And so what we're going to do is use the bank statement and the accounting records to figure out what the correct balance will be. And you should be able to find the correct balance both for the bank side and for the book side. Just a cash balance. So you're gonna have a corrected cash balance for each side of this. And so that's gonna be the reconciliation. These two are gonna reconcile. They're gonna be the same. So there's gonna be some stuff on the bank statement that we don't know, but there's also gonna be stuff that we know that the bank just doesn't know, or they didn't know at month end. And so this is what the bank reconciliation is all about. It's about taking those things that the other side knows, it doesn't know, or whatever. And basically, you want to correct the side that doesn't know, that doesn't have it. The things that on the bank statement that we don't know about, we want to correct our side. The things that we know that are not on the bank statement, we'll correct the other side. And at the end, we do all the corrections, we'll end up with those. Okay, so let's take a look-see and see how we do this. I was going to correct this, and like an idiot, I didn't. These are centered. I'm going to left justify. You don't have to do what I'm doing right now, but I was going to make them left justified, so they're not in the middle. Okay, so we have our bank balance, and this will come off of the bank statement. Okay, so the bank said that we had 5,000. And we'll have the book balance. $3,500. And that comes out of our accounting records. Remember way back when we did the T accounts? The T accounts, how much cash we had? That's what we're talking about here. The accounting record, basically the general ledger T accounts, whatever we have for cash there. So 3,500 would come off that, and then the bank balance would just come off whatever the bank statement is, end of the month bank statement. Now, one thing you'll notice immediately is these are not the same amount. So there's going to have to be some adjustments made for these two to equal out at the end. All right, now on each side, we are going to add some things. Yeah, you don't have to have things to add, but usually, hey, what happened? I know what's wrong. What's wrong is I took my mouse pad, migrated to what the camera should have done. Okay, so this is so there's things that we might add to each side, and there's also things that we might take away. From each side. Because right now they're whatever $1,500 apart, and at the end they're going to be the same. Okay, so far we've done these two. So we got those two down. I'm going to cross them out so that we know we're done with those two. Okay. The rest of these are things that we have to make adjustments down here to our bank reconciliation. And I think I'm going to explain something. First one is deposits in transit. What month is it? 131. So these would be okay, so deposit in transit. These are cash deposits that are made at the end of the month. So whatever the end of the month, it could be on the 30th, but usually the 31st. And so you deposit the money in the bank, and there could be checks, there could be cash, or currency. Those are usually the things you'll find in those. So the deposit's made at the end of the day, 31st, January 31st. Now, is the bank going to immediately credit your account? Are they immediately going to put money in your account? No, it usually takes a day or two to do it. And you guys will know this. For instance,
usually not, right?
Yeah, if you put money in an ATM, for instance, if you deposit your check or whatever in an ATM, it takes a day or two for it to get in. Okay, so that's a deposit that you made. You made the deposit, but it's just not going to show up on your bank statement. The bank doesn't recognize it yet. And that's what we're talking about for deposits in transit. So we know we made these deposits. The bank just doesn't know. Okay, so that's a deposit in transit. So let's go back to. So this is one of those things that we know what we did. We know we made the deposit, but the bank doesn't know. Okay, so it's like this one. We know we made that deposit. The bank doesn't know. So which side are we going to correct? The bank side or the book side? Who doesn't know about these deposits?
Bank side.
Bank side. Add or subtract, what do you think? Deposit.
Add.
And so deposits in transit always get added. Those always get added in. Okay. And so that would be 1485. Okay, so we're going to add a deposit in transit, and deposit in transit will always get added in. You can, and those are one of those common things that is almost every month. If you're in a business, unless you happen to be closed at the end, the last day of the month, if you're running a restaurant or your own business or something like that, you're going to have deposits in transit because, especially if there's checks in there. So Take a little more time. Okay, question on that? So the book side, we knew that we made those deposits. The bank just doesn't know. So the bank is the side we have to correct. Okay, let's send checks.
Deducted?
Huh?
Do they get deducted?
So one more time. They get what? Oh yeah, yes. Yeah, you're right. You get deducted. You're absolutely right. You're way ahead of me. But yeah, checks were written before 1-31. Okay, so we write these checks and put them in the mail, and it's going to take some time for. So let's say we mail them out on the 31st, or even a little before then. It's going to take some time for the mail to get it to whoever the check's going to. It's going to take time for them to take the check out, take it to their bank, deposit it, and clear the bank. So it's going to be a little while before our bank knows. And you are absolutely right that these will be. We know we wrote the checks. The bank just doesn't know yet. The bank doesn't know what check we wrote. So these will be in our the bank's bank balance, and they will be subtracted. So we wrote 1,250 checks that the bank just doesn't know about. Not at month end anyway, so they put the bank statement on it. And so these two are virtually every month you're going to have these. Deposits, transit, and outstanding checks. These are, most businesses will have these. You may not have deposits in transit. You make deposits once a week or something. You may not have it, but for the most part, you're going to have, and certainly the outstanding checks you'll have, especially if you don't use electronic transfers. Okay. So those are things that the bank didn't know. Okay, let's go to bank fees. When are you going to find out what the bank fees are? When you get the
Statement?
Yep. So this is something in the bank statement that you don't know, and there could be fees for different things, but you don't know about them. And here's why you don't know about them. Did you write a check for those? No, the bank just takes it out. The bank doesn't wait for you to write a check for the bank fees. They just take it right out of your account. We got your account, we're taking the fees out. So there is no check. And that's one of the things that we have to put it on the bank reconciliation. If we wrote a check, it would just be like any other check, but we don't write a check. They just take it directly out of our account. So we have to make an adjustment in our book. Now, would it be an add or less for the bank fees, for the cash balance? So pay the fees. Is our account going to have more cash or less cash? You guys are toying with me. You guys know this. Less. Good. Yeah, so the bank fees are going to be taken out. Again, there's no check for those. They just take it out. Maybe crossing these out as we put them in.
I'm sorry, Professor. I think I missed it. Why do the bank fees go under the book balance?
Because we don't have anything on our books. We didn't write the check for that 25. We see the bank statement. We see that they took out 25, but we won't have that anywhere in our books yet. So we have to adjust our books down. And so it's kind of hard to see now, but at the end of this, we'll kind of take a look and see what happens, kind of why we do this.
Okay.
Yeah. Okay, so bank fees, again, there's no check written for those. They just take it out of your account. Don't even ask, they just do it. Okay. So they take out the bank fees. And so we have to put that in our book somehow to it because we want to get this adjusted to the correct amount. See what it is. And right now we know there's $25 less in there because of the fees. Okay, note collection. And this one's a little bit tricky, and the question is, well, what is a note? A note is basically a post-dated check. It's a legal document. It's just like a check. In a check, when you sign your name, whatever amount is on that check, you're on the hook for. And that note actually carries that value. Whoever has that check, it's worth whatever's written on there because you assign your name to it. It's a legal document saying that you owe this to whoever has that check. Okay. A note is the same thing, but usually it's for a check is usually on demand. Bring it back, even if you post date it, a lot of times it's cash, it's on demand. But a note will actually say this is going to, that will pay you in 30 days or 60 days, or it could be a year or whatever it is. But it's just like a check, except that the date that you can collect your money is in the future. And also, oftentimes they'll collect interest on top of whatever is owed. So if you owe $1,000 on the note, when you pay it off, you're going to pay the 1,000 plus some interest on it. So it's actually a little bit better than a check, even because it has that interest payment. That you get a little extra depending on when they pay it off. So again, a note very similar to a check. It's a legal document. Whoever signs it is obligated to pay that amount. Now, because it is similar to a check, it makes sense to have the bank take care of it, right? I mean, so for example, let me give you an example. Let's say this is a bicycle shop, okay, and someone comes in and buys a fairly expensive bicycle for $1,700, and they say, "Can I give you a note?" Okay, so they give us a note. We know it's kind of like a check, and okay, it's similar to a check. So they give us this note. Now, we're not in the business of collecting notes, just like we're not in the business of collecting checks. So it makes sense to give that to somebody who is. And so banks are in the business of collecting checks and notes and whatever else, financial stuff. So it makes sense to give to the bank. They'll probably charge us a fee to do this, but they will collect the note for us and put the money in our account. Now, notice that we didn't make a deposit slip for that. They just put the money in their account. So we didn't actually physically go to the bank with $1,700. They collected it, they put it in the account already for us. So do we have to correct the bank side or the book side?
Book side.
Book side, add or subtract? Add or less?
Add.
Add, good. So note collection. So they collected our notes, kind of like collecting a check similar to it. Oh. And they will put the money automatically in our bank account. Let me put a plus in front of that. Oop. Okay, just a plus, no space. Play with the margins anymore. Okay, so collected the note. Interest income. Well, first of all, your bank balance might earn some interest. So whatever balance, you have a balance in the bank that's showing $5,000, that very well could be earning interest. And this note may also have added interest. We don't have enough information, probably doesn't matter, but there's gonna be interest on that note that we collected, depending on how long it was out and all that kind of stuff. So the question becomes, well, what do we do with it? So we'd probably find out about this on the bank statement, how much interest was collected. So which side are we going to correct, the bank or the book? You guys know this. Oh, come on, somebody make a guess. Be wrong once. Anyone?
Book.
Book, add or less?
Add.
Yep. Interest income. So this will be added in. So these are all things that we didn't know about, that we found out about on the bank statement. These are all things the bank didn't know about that we had done. They didn't know about our deposits. They didn't know about our extending checks, at least not at month end. So we make these corrections on the bank side. We make these corrections on the book side. Now, at the end here, we should have a corrected balance that is the same for each of them. And this is a time for Mr. Calculator. Okay, so we're going to add up the do the bank side first. $5,235. We should get the same thing over there. Oh, I did. I did something wrong. Let's try this again. Okay, so yeah, 5,000. So these two sides have to equal. Just making some room here to make a note down here. Okay, now, so here's what would happen after we do this bank reconciliation. So we do the bank reconciliation, we get to where both sides equal, so we know this is the correct balance. It has to be the same on both sides. So we adjusted the bank side to the correct balance, and the book side of the correct balance. Now, this is what we have on our books right now, 3,500. So we need to make these journal entries to get it up to this amount. Now, I'm not going to require in this class to do that, but that's what we would do for these. We would take for each one of these, we would take those and let's see. And we would make journal entries to get those into the accounts. Hold on a second. So we make journal entries to correct the balance in the cash account. For example, I'm just doing you do not need to put these in. Just doing this as an example. For the first one, say cash. For the note collection, you say cash went up by. So you'd say cash would be a debit. And that might be a note receivable. So for instance, that would be this one. This one would look like that. Yeah. So that would take care of this. So that would put this on the books. So this would be an asset increasing. Yeah, and do this with cash, interest income, bank fee expense, cash, whatever it is. So for each one of these, you would go through and make a a journal entry for it to adjust the cash to whatever whatever the corrected balance is. So each one would have a separate journal entry. And this is one of the reasons why you do it, by the way, so that you can know exactly what's in your cash, because it makes a difference. If you think you have 3,500 and you really have 5,000, it could make a difference in how you run your business. So, okay. There's a tricky part to this one, number 2, and it's this. Nsf check. This is a check that was received from a customer. Was deposited but it did not clear. Kind of wordy, but it's really wordy. I thought I could do that. Okay, so we received cash from a customer. Received check received from the customer. So we take the check, we deposited it thinking it was good. Maybe even have checked on it and see if it was good. But it did not clear. In other words, it didn't have enough funds to cover it. So NSF stands for non-sufficient funds. Now this isn't, now we didn't write the check, the customer did. So this is a check that the customer gave to us. So we got the customer's check, they handed us the check, we put it in with our deposits, we went to the bank, deposited it. Bank kicks it back and says there's not enough funds in this customer's account. You know, the customer's bank, or could even be the same bank that we use, said there's not sufficient funds for this check. Okay. So what do you think we do with that? Now, we recorded it as a deposit in our cash, right? We made a deposit of cash and we recorded it in there. So, okay, we have this cash. I forgot how much it was already. 120. Okay, so we took this check for 120. We put in our cash. We made a journal entry that had this, you know, this check for 120, and it didn't clear. So, what do you think we do with that?
Does it get added to the bank balance?
Actually, the bank balance, they probably they never put it in, most likely, because they never got the funds for it. So this is a check that is no good, basically. Now we'll probably find out about it when we get our bank statement back. So what are we going to do with that? We already included it in our cash, but it's not there. There is no cash for that one. So what do you think you probably do with this NSF check? Now the bank probably has it right. The bank, you know, they tried to collect it, couldn't do it. They're not sufficient funds. They don't. There's not enough funds in the account. So the bank doesn't have, you know, never collected the money. I would assume that their bank, you know, they probably never even had it in your account. So whose side are we going to correct, the bank or the book?
The book?
Book. And will this be a plus or a minus?
Minus?
Yep. Yeah, we put it in, and now we're not going to forget about the money. We're probably going to call up the customer and say, okay, we're going to get, you know, come and pay cash and get your check back, or whatever we make the arrangement. But yeah, it's going to be on the book side, and it's going to reduce our cash. And it's going to mess up my. Okay, so yeah, so this is what we're probably going to be looking at doing for that one. And again, you know, this is also one of those things that happens every now and then. The rest of these, I think you guys can all get. They're similar to what we did before. So maybe I'll be quiet and see if you guys can figure out this. Oops.
Professor, isn't outstanding check supposed to be the negative 1,150?
Yes, it is. Thank you.
No problem.
Yeah, it's one balance. $13.20. Okay, 13. Well, 1,320. So that would be our bank reconciliation. So these two sides are equal. Oh. And we make journal entries for these. Well, I'll tell you which one on here would be the most unusual of the journal entries. That'd be the Nsf check. Because we wouldn't just forget about it. You know, we'd have to take it out of cash. The question is, what would be the debit? And the debit would be accounts receivable. So, you know, that we would say, okay, they owe us one, you know, this would be, they owe us 120. So we take it out of our cash because we don't have the cash right now. And we would put the accounts receivable on the books. And this is what we did. We focus on collecting. Yeah. So that one's a little bit unusual. Question on that thing? So that's a very common thing to do. And again, part of the reason for doing it is you want to know what your real cash balance is. And also you can find a lot of things that happen if someone's stealing money from you. A lot of times this will catch it also. You know, so if someone is actually stealing cash, a bank reconciliation can many times pull that out, because what's put on the books and what is put in the bank would be two different amounts. You know, so there's a lot of checks and stuff going on here. Any question on that? Okay, well, we'll go over a break in a second here. I'll tell you, I don't know if this is amusing or not, but when I was going through assessing accounting classes, my first one was to a community college taking, and I was not a good, I think it was a C student in accounting. But anyway, which you guys can probably tell by the way. But the one thing that made sense to me was the bank reconciliation. And I actually started doing it and checking accounts. So, I'll do the bank reconciliation. So I did it. I was doing it every month. I get to do the bank reconciliation. Everything was fine. And then after I did this for like a year or so, whatever, it didn't balance, and it was off by $500 exactly. So $500 exactly it was off. And I went through and I kept doing it. This can't be right. This is, I went through it. Everything I did was right. It was off. Then I realized that the ending balance the month before, which should have been the beginning balance, I can't remember what month it was, but let's say the ending balance of June, should have been the beginning balance of July, right? It increased by $500, from the end to the next day, and there's nothing in there that showed it. It just the balance went from whatever it was, 2,000, let's say, to 2,500, and that was just it. So like, oh no, I figured, okay, the bank's going to catch it. So I went to the bank. I told them, look, this is, here's what happened. If you look at this ending balance, the guy said, well, you probably made a deposit that you don't remember. I said, no, there's no deposit. It just went from 2,000, whatever. It's exactly $500 more. And you probably made anyway. No, it's fine. It's correct. Your account's correct. Okay, well, so I always thought, okay, this is going to come back. So I always saved all the stuff because I knew it was going to come back. Hey, there's an extra $500 in your account. I said, well, I told you. So anyway, probably like another year or so goes by, and now I'm going to go down. And I went down to Illinois State. So I went to the bank. I said, look, I'm closing out the account, but I want to tell you that, a year and a half ago or whatever, that this happened, and this is, I call a manager. Oh no, it's fine. It's fine. Your account's fine. No, look, I'm withdrawing the money. So just withdraw the money. You take it all out. That's fine. So anyway, I ended up getting an extra $500 for no reason. They never came back to me. So it was a weird thing, but it was like a bank reconciliation. And embarrassingly, it took me so long to figure out what had happened because, like I say, I didn't realize that someone from banks said that they have to do something to balance the books, or they get in trouble, and so that it may have been one of those things. But anyway, a weird story about how, and to this day, no one's ever came to me and say, "Hey, that $500, that's $500." So anyway, so I think let's go ahead and take a break. What time is it? Oh, it's 7:00. So let's say, I don't know, 7:10. Come back, or you guys want to come back earlier? Let's say 7:05. So at 7:05, we'll come back and we'll start on chapter 8 stuff. It's not very long either. And then and this will be the last thing that we do before break. So there's a break, get the test in if you haven't already, and should be clean for your week off. Okay. I guess I really don't need to put the PM in there. You guys probably you make a 7:05 in the morning and no one was there. What the heck? Okay, we're going to start on chapter 8. Chapter 8 is about accounts receivable. And up until now, we've always assumed that the accounts receivable would be collected. Whatever's in accounts receivable will be collected. And for some companies, that is the norm. The problem is a lot of times if a company has a lot of accounts receivable, that they will have some that they don't collect. And the reasons are wide ranging. Someone could go bankrupt, someone could die, someone could leave the country. There's all kinds of reasons why you don't collect on accounts receivable, especially if you have a significant number of them. So that's what this chapter is kind of about. And for accounts receivable, there's also the problem of the timing of it, because you might make a sale in one year and not realize that the account is bad till the next year. Now, common sense would say, okay, you keep, for instance, revenues from 2020 should be matched up with expenses from 2020, right? I mean, you want to match the revenues from the same year with the expenses from the same year, whatever year that is. But there is a timing problem that you'd have with doing that, because you might not know at December 31st that a certain account isn't going to be collected. So, and quite honestly, if you knew that the account wasn't going to be collected, you probably wouldn't have sold it to them in the first place. But so there could be a timing difference of when you find out that an account is bad, could be in a different period than the current period when you made the sale. And so that's kind of what this whole kind of chapter that we're going to go through now is kind of the whole idea behind it. So a thing called the matching principle. Make it green. And that is that the revenues and related expenses be recognized together in the same period. So any expenses that relate to the revenues should be in the same period. And that, of course, is kind of common sense. You wouldn't have revenues for in 2020 versus expenses from 10 years ago or whatever. It would be for the same period. But that makes a little bit of a problem here. So for this example, we recorded the sale in, so you record the sale in 2020, December 4th, and then you find on the next year, February 13th of the next year, that it's not collectible. Now notice if you're not doing something, if you're creating the sale here and the expense here, you're separating out the revenues and the related expenses. This expense, where's my little insert stuff here? That expense relates to the previous year. This is not for a sale that was made in 2021. This is for a sale that was made in 2020. Again, the problem being at year end, you don't know this is going to happen. Right? You don't know which accounts are not going to be collected. So that's a problem. And that's kind of what this whole thing is. And what we do is we actually have what they call allowance methods. And they're going to be an allowance account. And that it's a contra account. Similar to accumulated depreciation. It's going to go against the accounts receivable. And it's there because the accounts receivable balance that's in the accounts receivable is probably not realistic, that there's going to be some accounts that go bad. So we'll say, okay, we're going to estimate those accounts that are going to go bad. Now, is it going to be 100% correct? No, it's an estimate. it'd be strange if it was 100%, you know, correct down to the penny. But it's going to be an estimate of what we think is going to go bad that we're not going to be able to collect. And you can't just write the account off because you don't know who it is. You know, and quite honestly, I mean, even the people who, you know, even the people that bought the stuff maybe didn't know they were going to, you know, that they're going to have hard times or whatever. So, you know, nobody, it's very possible nobody at year end knew anything about this was not going to be collectible. Okay, and allowance methods. There's actually two of them. They use a estimate. And these are the two. Percentage of sales and percentage of accounts receivable. Yeah, I goofed it up. So both of these methods are estimated, they're estimates. They use estimates. They use an allowance account. That's where this allowance thing comes in. The one that we're going to use in this class is going to be the percentage of net sales. Just because, you know, the whole idea is to give you an idea of what is, you know, that we're making an estimate on it. Both of these, actually many companies will use both of these methods. So there's two methods, percentage of sales. There's also this method, percentage of accounts receivable. Either method is fine. Either method is fine. There's you know, they're both acceptable. And usually what they do, hopefully, if you've been in business for more than a year, how do you estimate it? Well, see what went bad, you know, see what was uncollectible last year. You know, how many, what percentage was uncollectible last year? 2%? Okay, well, let's use that for this year then. We'll say, you know, the actual amount was bad was or uncollectible was 2%. We'll use that for this year. Okay, so estimating the amounts. Okay, so uncollectible accounts recorded, you're not necessarily detaining. The allowance account. Let's just jump into it. These aren't that hard. We should finish early tonight. Yay! Okay, so I'll put that. I kind of scrunch these up. I don't know why. I'll see if I can put it on here. Okay, it's estimated that so here are some of the accounts that we have. We have accounts receivable, debit. That's an asset, right? So you would expect that that would be a debit. That's positive. You wouldn't have negative accounts receivable. But now we have this allowance for doubtful accounts that you notice is a credit balance. So it is going to reduce those accounts receivable. So this, let me move the sales out of here for a second. Is there an E in there? No. No, it'd be receivable. Okay. Oh, wait, what do I have? No, I did have it right. It is receivable. All right. So this allowance for doubtful accounts. This is a contra account to account. So this goes against the accounts receivable. So the accounts receivable, before we make this adjustment, really isn't worth 55,000. It's worth 55,000 minus 1,000. What, 54,000, I guess. Now we're gonna make some adjustments, so it'd be worth even less than that. But we'll go ahead and make the adjustment. Okay, so let's go down here. So A says the estimate of estimated that 2% of the net sales will be uncollectible. Okay, so we have sales. Times 2% equals some number. Time for Mr. Calculator. Hello, Mr. Calculator. $300,000. So 6,000. So this is our estimate. And again, the reason we have to do this is we do not know who is not going to be able to pay. If we knew who it was, we'd just write off their account, but we don't know who it is. Okay, so this is the journal entry, 12/31. So we'll have uncollectible account expense, sometimes called bad debt expense. I can't remember what the book uses. Anyway. Could be allowance for doubtful accounts, could also be allowance for uncollectible accounts. A couple different ways of saying it. So this would be our journal entry. And I am going to put this on a different page. And I should have put a T account in here. Because it looks sort of like this. I'll make a T. These are probably terrible. Accounts receivable. Okay. Again, this is probably going to look terrible, but you get the idea. So we have 55,000 sitting in the accounts receivable. And we had 1,000 sitting in the account before we made this entry. We added another 6,000 to it. Which gave us a balance of 7,000. Okay, so this is how this would look on our. This is how this would look on our balance sheet. What kind of an account is accounts receivable? Oh, come on. What kind of account is accounts receivable on the balance sheet? I'll give you a few choices. Could be an asset, could be a liability, or could be equity.
Asset.
Yep. Good. So underneath the assets, be a current asset would be more precise, but asset's fine. We would have our accounts receivable. And then underneath there, we subtract out our allowance. And so we'd have our net accounts receivable. Uh, 55,000 minus 7 is what, 48,000? So this is what we would actually have as our true value of our accounts receivable. You know, the true value that we would have for our accounts receivable would be 48,000. Why? Because we think that 7,000 of it is not going to be collected. We don't know who it is. You know, it's not going to be collected from, but we are estimating that 7,000 will be collected. So this is really the value of our accounts receivable. Yeah, so that's how this would kind of, you know, and these two accounts here. What colors do I use? Okay, I'll use green. These two accounts here are kind of linked at the hip. They go together for ever and ever. So, you know, so these accounts go together. This is a contra account. This goes against the accounts receivable. And again, it's there because we don't, this account is necessary because we do not know And I turned you off. So we have this allowance set for the accounts that will not, we don't know are gonna be reflectable. And we're not going to do it in this class, but we would also write off accounts to this account. So as you found accounts that were bad, say, okay, we already have set aside here some amount. So let's say that you find an account, let's say that so if you find the Fred's count is uncollectible in January, what do you do with that? Well, you already set aside some here for this very reason. So you take 300 out of it, and you'd write off his account for 300. Oops. You've already set up that this will take, this is an estimate of what's going to go bad, and now you just figure out who it is. Now, again, you don't have to put that in. I just kind of rounding it out for you here. You take Fred's account off the books, and there's already an account set up to take Fred's account, and it's already been expensed. Fred's account is already expensed. We just didn't know who it was. This has been expensed. So you're not going to expense Fred's account when he can't, for whatever reason. It's simply going to be taken out of the allowance in the accounts receivable. Kind of weird in the way it's set up, but this is set up. These are basically just a timing difference. This is a timing difference. We don't know who is going to go bad, but when they do go bad, we already have this account set up to take, not that, just this account set up to take care of them. And so this is what it looked like on the balance sheet. And a lot of times you'll see companies, they won't show any of this. They'll show net accounts receivable. They'll put it in the notes why it's like that, but a lot of times you'll just see this as one line item on the books. Okay. This one is a little bit trickier. And this goes to what we talked about in chapter 6, the net sales. So in this case, we had sales of 630,000, and we had sales returns and allowances of 10,000. So what were the net sales? Remember that? Way back when, last week, I was there, you were there. Probably other people were there. Oh, you guys are toying with me again. What would be the net sales? We sold 630,000 and they returned 10,000. Okay.
620,000.
Yep, good. Thank you. Yeah, this is correct. All right, so these are the net sales, and so that is what you're going to use when you do your estimate. This is what you're going to use when you to do that estimate. So, all right, I'll be quiet and see if you guys can figure that one out. So uncollectible accounts expense. So we don't need this. You don't have to do this. I'm just kind of putting it in here to kind of explain it. Oops, no, that was not right. That'd be 599, 400. I better check. 620,000. Okay. So that would be what they would have on their books as their net accounts receivable. And a lot of times that will be the only one that the only amount they give. And I'll show you the example of that in a second here. Any questions on any of this? And again, we're setting up this allowance account because we don't know who's going to go bankrupt. If we did, we would write off their account or we wouldn't sell it to them in the first place. But we don't know who it's going to be. And even the people that might be going bankrupt or leaving the country or dying, they don't know either. So it's one of those things that nobody knows. And so we're making this estimate, and this estimate is we don't think we're going to collect 620,000. We think 20,600 is not going to be collected. And so this is really what we believe we're going to collect on this. Any question on that? Okay, I'm going to show you, this is the Ford Motor Company. This is from a few years ago. This is 2017. This is kind of unusual. Usually the 2017 would usually be the first one. The previous year we've had, doesn't really matter. But you'll see, you know, they have financed. Let me zoom in here a little bit. If I can't. So the finance receivable, they'll say net. And then they'll say, oh, by the way, go look at note 10. So there's note 10 at the bottom of the financial statements that you can take a look at. And here's some trade receivables, less allowances, just like we talked about, for 392. So this would have 392 was already taken out of it. you can figure out what the total would have been. You just take 11,102 plus this is what they think is going to go bad. And again, they just don't know who it is. So they think that, I think these are millions. Yeah. So I think there's $392 million of bad, the accounts, they just don't know who it is. And for 2017, it's 412 million. And again, they just don't know who it is. So this one, they'll tell you right away what the allowances are. This one, they took them out, but they didn't tell you how. So they said, go look at the note and you'll figure it out. So anyway, by the way, this document that we're looking at here, this is what they call a 10K. And this is what's going to the Securities and Exchange Commission. Any publicly traded company has to file this. And these things could be hundreds of pages. This one is 235. I've seen ones that have gone over 1,000. But this is what they have to turn in. And if you ever have to look for the financial statements, they're usually about halfway down. Usually about halfway down the middle there, you can find the financial statements. Yeah. So there's quite a bit of stuff that gets filed, but I mean, at the same time, it's basically, as you saw, it's the same thing that we had, before. They have allowances just like everyone else has allowances for alpha accounts. Any question on that? Well, that is it for this week. I'll put a thing to submit this handout in Blackboard. And you just need to get the chapter 6 exam if you haven't already. I know about half of you have already got it in. But and that's it. And then over break, you're not going to do anything in accounting over break. You might do other things, but you're not going to do accounting over break. Any questions on anything? Okay, well, I will see you guys in 2 weeks. Have fun, stay safe, and I'll meet you in 2 weeks, and we'll pick up from there. So I'll put a drop for this thing in the Blackboard, and that's it.
Thank you, Professor. Have a good night.
All right, good night.
Have a good one.
I will, you too. Thank you.
Hey, Professor, I had a quick question real quick. I don't know if you were still there.
Yeah, I'm still here.
So two things. So for Blackboard, for the practice exam for the chapter 6, I only see part 2 on there. So should I turn in part 1 and part 2?
You just need to turn in part 2. If you recall that part 1 was the multiple choice questions, and we did those in class, and you'll get extra credit points for those.
Oh, okay. So we only need to turn in part 2 though?
Exactly. Yeah, exactly. Some people have turned in part 1 also, and there's nothing wrong with doing it. So if you're that's fine too. But part 2 is only the really one. I should maybe start having you turn in the multiple choice questions, but especially because that one had a few more calculations than usual.
Oh, okay.
But I didn't have it in, but there will be extra credit points. Those 3 extra credit points will be added up to the test for anyone who's there.
Okay. All right. And sorry, I had one more question too as well. So for the FIFO, right? So you know how we after like the dates, like the balance, we put like need to find the cost for, etc., right?
Right.
So one question that I had was there for the need to find the cost for, like the number, it should never be negative, right?
Correct.
Like it should never be a negative number.
But it can go down to 0, but it can't be negative. So
okay.
So for instance, if you need 40, but there's say 60 in the layer, you just take 40 of them. You don't take all 60.
Right.
Yeah.
Wait. Yeah, because I'm okay. Never mind then, because I guess I did something wrong then.
Yeah. So if you go negative, then this whatever number it would, whatever last number you need, you only take what you need.
Okay.
Yeah.
All right. Thank you.
Yeah.
I have a question.
Sure.
For the question 4, like what we just did,
Yeah.
For the accounts receivable, you put, I guess, the 620,000 or something. I was wondering if it was that. I thought for the last one we put 80. I thought we had to put like 85,000. You know what I mean?
No, you're right. You're absolutely right. No, you are right. This is wrong. Thank you. Hey, you know what I should.
I just didn't see it before, and I was like closing my finger and I just saw it. So
Wait till the class to be over. Come on. Yeah, no, but you're absolutely right. It should be 6:30. Because yeah.
but like so like should it be 630 or like since we say like accounts receivable, should it be like 85,000? Are we putting like the sales down there? Or like,
No, you're absolutely right. I'm writing crazy things out here. Let me send out an email on that. Jeez, that was terrible. Okay, so this is what did you get? 60
well, and then
400?
yeah.
Yeah, that's what it should be. Let me. I'll send out a correction for the class on that. Because yeah, 85,000 is the accounts receivable. 2,000 credits, so that's in there. So yeah.
Yeah.
Stupid mistake. Stupid mistake twice. Yeah. I'll thank you for letting me know that.
Yeah, no problem.
I'll send that out. I'll do that. I'll do it right now. Okay.
Thank you. Have a good one.
Thank you. That was
No problem.
that would
Bye.
have been bad because all right. Yeah.